You guys know I love dividend stocks. I've talked a lot about dividend stocks recently on the channel, about how dividend stocks can lead to significant income over time that always goes up. Talked about how dividend stocks can beat the S&P 500 and how my own dividend stock portfolio outperforms the S&P 500. And I've gotten a lot of great feedback from you guys in the comments, but one of the things that I want to address today is one of the comments that I get a lot, especially when I talk about gains over time and dividend income over time, which is, have you incorporated taxes in your analysis? That's a great question, and it's worth answering, and I'm going to answer it in this video, and how taxes can affect our own personal unique situations, because every situation is different. In this video, I promise to give you the most comprehensive video here on YouTube with respect to dividends and taxes. We're going to talk about in this video the three major components that are going to affect how much you pay in taxes with respect to dividend income. We're going to break down for you the difference between qualified dividends and ordinary dividends. We're going to talk about the history of how dividends have been taxed over time here in the United States. And we'll talk about how dividends are taxed here in the year 2021. So if you're here for the short answer to this question, are dividends taxed? The answer is yes and no. Any questions? I thought so. Let's get started. Hey guys, before we get started, make sure to hit that subscribe button below the video to ensure you do not miss any future videos I post. Make sure to leave a comment below saying you subscribed, and I promise to respond personally to your comment. All right guys, you know how much I value your time. I never want to waste your time, so let's go ahead and jump right into the content here. Before we even get started here guys, I need to make a very significant disclosure. I am not a financial advisor. I'm not a licensed financial professional, though I will be in the near future. I'm not a tax professional. I cannot give you tax advice. I'm not giving you financial advice. Please, before you make any significant decisions, seek the advice of a tax professional and a financial advisor. First thing I want to share with you guys is the history of dividend taxation here in the United States, because it's kind of important to understand, not only how dividends are taxed now, but the history of dividend taxes, to understand one important concept, which is, I understand how dividends are taxed now, but can that change in the future? I found this great post on suredividend.com's website I want to share with you guys. I'll link to the article in the description below for your reference. It's called The History of Dividend Taxation from 1913 to the Present. It's a great article here. It's a guest contribution from Logan at the finance blog Money Done Right. If we go down here, it talks about how dividends have been taxed in different ways over time, starting back from 1913 through 1935. Did you know that dividends were not taxed, federally at least? Dividends were exempt from the normal income tax. Dividends would continue to be exempt all the way until 1936. They probably needed to start increasing the money coming in for taxes after the Great Depression. Here's an example from the 1040, back in that time frame when there was a deduction here from our gross income. Here, dividends were deducted. So can you imagine not having to pay taxes at all on your dividends? Now, to be clear, there are ways right now to not pay taxes on dividends, but it's not universally exempt from income like it was back from 1913 to 1936. From 1936 to 1939, dividends were taxed at the ordinary income tax rates, meaning there was no benefit to being paid with dividends than there were from just working at a job. They were taxed in the same way. Then from 1940 to 1953, as it says here, dividends were again exempt from the normal income tax. Through the 1940s and early 50s, dividends were generally exempted from taxation as they were before the Revenue Act of 1936. Then from 1954 to 1985, there were some partial exemptions and credits. As it mentions right here, beginning in 1954 and for the next 30 years, dividends were taxed at normal individual income tax rates, but with a certain exemption amount being excluded. $50 per individual in 1954. A 4% tax credit was available for the amount of dividend income in excess of $50 per person. So it was somewhat discounted, but for the most part, it was still taxable at ordinary income tax rates. This was all the way through 1985. Then from 1985 to 2002, fully taxable. And then the big change here happened in the year 2003 in conjunction with President George W. Bush signing into law the Bush tax cuts. One tax law was signed in 2001, the other in 2003. The second one was called the Jobs and Growth Tax Relief Reconciliation Act of 2003. And this is where they differentiated between qualified dividends and ordinary dividends. And we're going to talk more about ordinary versus qualified dividends here very shortly in this video. But the important part to understand here is then this is where there was a significant benefit to being paid in dividends as opposed to ordinary income. The big takeaway here was These dividends that were known as qualified dividends would be taxed right here, not at the ordinary income tax rates, but at the preferential long-term capital gains tax rates, which is what you can only generally achieve when you've owned an investment for at least 1 year. One thing I thought was very interesting is it says here, interestingly enough, Bush originally wanted to end the double taxation of dividend income. Yes, he was actually calling for the end of the taxation of dividends. And the important part to understand here is that dividends are actually a form of double taxation. Corporations, when they pay taxes, they have to pay taxes on their overall income. And then from that income, they then pay dividends. And then those dividends are then taxed again at the individual investor level. It's double taxation. So from that perspective, you could say, well, maybe they shouldn't be taxed. Now, the reason why I share this with you is not so that you can pass a history test or know necessarily what happened with dividends in the past. The important thing to understand is that tax law in and of itself is a fluid topic, a fluid policy for our federal government. At times, dividends have been fully taxable at ordinary income tax rates. At other times, it's been fully exempt. And in between then, it's had some favorable tax treatment. And right now we do benefit from some preferential tax treatment in the form of the long-term capital gains rate. But you should know that nothing is for sure. In the future, they could fully exempt dividends. I doubt it given the level of federal debt we have, but it could happen. And on the flip side, it could then be fully taxable at ordinary income tax rates. We don't know, we can't, and we shouldn't invest based on current or future tax policy. So we just don't know what's going to happen. But what I can tell you is, despite tax laws, dividends are still an amazing investment right now. Let's talk now about what makes up our current dividend tax rate and the 3 major components that affect whether or not your dividends that you earn are taxed at all. So whether or not you pay taxes on your dividends and how much you are taxed depends on 3 major components. The first is the type of account that you are receiving your dividends in. The second major component is the type of dividends you receive, qualified versus non-qualified dividends. And then the third major impact is your taxable income and your tax filing status. If you are receiving dividends in a retirement account, such as a 401k, a Roth IRA, a traditional IRA, a SEP IRA, a 529 plan, a Coverdale plan, any type of tax deferred or preferential tax account for retirement or investments for kids, things like that, then dividends are not taxed at all. Now, depending on your account, you may be taxed on withdrawals from the account as distributions for a traditional IRA or perhaps a 401k, though if those are Roth IRA accounts, then that won't be taxed at all. Now, one thing you need to be aware of is the exception to that rule regarding retirement accounts, when you might actually owe taxes even if the dividends you receive are within a retirement account, and that is known as unrelated business taxable income, or for short, UBTI. It usually most often relates to master limited partnerships, which is a type of account that I actually own in my general taxable account. Now, master limited partnerships generally have distributions that are not taxable in the moment you receive them. They actually instead affect your cost basis in the investment. We'll talk more about that soon. But parts of the distribution could be known as UTBI, or unrelated taxable business income, and that amount, as long as it does not exceed $1,000, is not taxable. But if you receive more than in your IRA or retirement account, if you receive more than $1,000 in UTBI, then you have to file a different tax form and you may have to pay taxes on that amount of income, the unrelated business tax, business taxable income, whatever I just said. If it's over $1,000, you may have to pay taxes on that amount now as opposed to in the future. If you have further questions on that, please see your tax advisor. Plus, generally, any type of tax deferred investment, such as a master limited partnership, is best generally owned in a taxable account as opposed to a retirement account. Now, let's talk about the type of dividend received. Qualified dividends versus non-qualified dividends. To be considered for the long-term capital gains tax treatment, a dividend has to be a qualified dividend. So then the natural follow-up question would be what's a qualified dividend? What constitutes a qualified dividend? And thankfully the IRS has very clear language on this. So we're here on the IRS website here. It talks about qualified dividends. So qualified dividends are the ordinary dividends subject to the same 0%, 15%, or 20% maximum tax rate that applies to net capital gains. They should be shown on box 1B of the Form 1099 DIV you receive. The maximum rate of tax on qualified dividends is the long-term capital gains rate. That's what it's telling you here. So to qualify for the maximum rate, all of the following requirements must be met. These are known as the qualified dividend criteria. The dividend must have been paid by a U.S. corporation or a qualified foreign corporation. The dividends are not of the type listed later under dividends that are not qualified dividends. We'll cover that in a second. And you must meet the holding period discussed next. So, holding period. You must have held the stock for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. That's confusing. Now, just to be clear, that holding period is there by design to make sure that people are not buying a dividend stock right before the ex-dividend date and then selling it to capture the dividend. There's no benefit to doing that because the stock price goes down afterward. If you're owning dividend stocks, you should be a long-term dividend investor, and qualifying for this holding period shouldn't be a problem. But if you buy a dividend stock before the ex-dividend date and you sell it or get rid of your position within 60 days, then you're not going to qualify for the qualified dividend tax treatment. It will be taxed at the ordinary tax rates. Now, there also is an exception to the holding period. You have to be aware of this if you utilize options in your dividend portfolio. So pay attention here. Holding period reduced where risk of loss is diminished. When determining whether you meet the minimum holding period we just talked about, you cannot count any day during which you meet any of the following conditions. You've had an option to sell, were under a contractual obligation to sell, or had made and not closed a short sale of substantially identical stock or securities. You were a grantor or writer. In other words, you sold an option, you were an option writer, of an option to buy substantially identical stock or securities, or your risk of loss is diminished by holding one or more other positions in substantially similar or related property. In other words, make sure you see your tax advisor. You consult with them if you are utilizing calls or put options with respect to your dividend portfolio, because if you sell a dividend stock, it may impact your qualified dividend status. There are some other one-off situations in the IRS. There always is. So if you have further questions, if you have a unique scenario, please don't see me. I don't know the answer. See your tax professional. They know how to look up the information within the IRS guidelines. As I mentioned, here's the list of dividends that are not qualified dividends. So if you have capital gains distributions, that's not a qualified dividend. If you have dividends paid on deposits with mutual savings banks, blah, 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 blah. Dividends from a corporation that is a tax exempt, blah, blah, blah. Dividends paid by a corporation. There's a lot of different things in here, but one of the things also would be return of capital. We'll talk more about return of capital, while that would not be a qualified dividend. Also of note here, if you happen to have dividends owned through a dividend reinvestment plan where you get a discount for reinvesting the dividend, where they might give you a 15% discount on the reinvestment of dividends, then that might not qualify as a qualified dividend as well, just for your awareness there. Now, here's the actual information. If you happen to have qualified dividends, then the last impact here is your taxable income as well as your filing status. Somebody who is a single taxpayer versus married couples filing jointly has a significant difference in the dividend tax rate here. So if you have taxable income under $40,000, well, then you don't pay any taxes on your dividends if they're qualified. If you're married filing jointly, up to $80,000. So if you have dividend income and your total taxable income is less than $80,000 for the year and you are married filing jointly, you don't pay any taxes on your dividends. That's a pretty amazing thing. Now, if you happen to have taxable income over $40,000 but less than $445,000 for single taxpayers, or $80,000 to $501,000 for married filing jointly, then you will be taxed on your qualified dividend income at 15%. That's probably a lot less than you would pay at your ordinary income tax rates. And then the last tax rate here would be 20% if you happen to have total taxable income of over $445,000 for single or $501,000 for married filing jointly. Now, if you don't have qualified dividends, then you are subjected to the tax rate of ordinary income tax rate. For 2021 here, a lot more tax rates here. We've got 10, 12, 22, 24, 32, 35, and 37% tax brackets. So for the first $10,000 for single, then you would have a 10% tax rate. It would be $20,000 for married filing jointly. Then the next bracket here would be from $10,000 to $40,000. It would be 12%. And that represents right here the potential gain here. Ordinarily, if you had qualified dividends that were taxed at ordinary tax rates, it would be a 12% tax rate, potentially up here, between 10 and 12% based on these brackets here, whereas it would be 0% if it's a qualified dividend up to $40,000. And by the way, dividends are still a great investment even if you're taxed on them, because in a lot of cases, you don't have to stop the dividend compounding and sell dividends to cover your taxes. For a long time, I imagine that you'll pay zero unless you have a significantly high taxable income, in which case maybe it's a better recommendation to have a lot of your investments be in tax deferred products such as traditional IRAs, when your taxable income might be lower in the future than it is right now. But for most people, for the average Joe out there, right, your dividends are going to be taxed, as long as they're qualified dividends, at a lower tax rate right now and in the future. Now we have two caveats to this general tax treatment for dividends and qualified dividends. We have real estate investment trusts or REITs, and we have master limited partnerships or MLPs. Now REITs and MLPs have preferential tax treatment as long as they pass at least 90% of their taxable income through to the individual shareholders of the REIT and the MLP. Then they are not taxed at the corporate level. Instead, all of those taxes will be based on the individual investors. For real estate investment trusts, the income you receive would be categorized one of three different ways. The income from a REIT might be ordinary income, taxed at the ordinary tax rate. It might be capital gains income, which would be achieved from when a REIT sells a property and there's a gain in that property. The capital gain would be passed on to the individual investors. And there might be return of capital as well, which does not result in taxes right now. It actually results in a lowering of your cost basis. If you happen to have capital gains or losses, then those gains will be taxed at the 0, 15, or 20% long-term capital gains rates for the year in which the gain is received. This assumes, of course, that the REIT owned that property for at least 1 year. Otherwise, it would be ordinary income. The income you receive from a REIT from just their general rental income will be ordinary income. And a portion of the REIT income might be return of capital when maybe due to non-cash expenses such as depreciation or amortization, potentially the income they receive is higher than their taxable income, in which case you would get return of capital. Now, MLPs are master limited partnerships, which means that they don't pay dividends, they pay distributions because you're a partner, not a shareholder in the partnership. Now, the distributions or dividends that you receive from an MLP are not taxed when you receive them. They're instead known as return of capital. So instead of being taxed on a dividend, instead your cost basis in that investment is lowered by the amount of the dividend per share. For example, let's say you have a $25 per share investment in an MLP. Let's say it pays $1 in annual dividends or distributions. So every year you get paid that $1 in distribution. Instead of being taxed now, your cost basis goes from 25 to 24. And then every year, 24 to 23, 22, 21, 20, until eventually when you sell the investment, at that point you will have a larger capital gain than most other investors. Your cost basis might be, let's say, $10 per share. Maybe you sold it for $27 per share, so you'd have a gain there of $17 per share that you would be taxed on. And that would be at the capital gains tax rate if it was owned for more than a year. Now, one of the beautiful things about master limited partnerships, and again, see your tax professional before you do something like this because it could have significant tax consequences. But with respect to return of capital, let's say you would like to pass on your investments in a master limited partnership or a certain amount of money to your heirs, and you'd like to avoid a tax hit on that. If you have these investments in a master limited partnership, and you are continuing to invest and you have that cost basis lowering over time, let's say you pass away and your tax base is only, let's say, $5 a share in an investment that's currently worth $30 a share. When you die, the tax is not placed on you. You don't have to pay any taxes on that tax basis you had. Furthermore, when the money is moved on to your heirs, they get what's known as a step up in cost basis. So instead of having to own that at $5 a share, they get it right there at the market value, $30 per share, and they don't have to pay any taxes. They could sell it right away. No taxes on that sale of investment income. That's a pretty sweet deal. So again, see your tax advisor if that's something you want to do, but there's some significant estate planning benefits with respect to master limited partnerships. So here's the takeaway. Dividends are taxed unless they're not. If you own dividends in a retirement account, then the actual dividends when they're received are not taxed. The exception there being UT or UBTI, unrelated business taxable income. That's pretty rare. That's going to happen with a master limited partnership generally. But otherwise, in a retirement account, you don't pay any taxes. If you own your investment in a general brokerage account and that investment is a qualified dividend based on the criteria we talked about, then the dividends you receive from those investments would be taxed at the long-term capital gains rates. If you receive returns of capital from your investment as opposed to dividend income, then that income is not taxed right now. Instead, it results in a lowering of your cost basis in the investment. Hopefully you guys learned something new from this video. If you have any questions or concerns, something you don't think I covered correctly or comprehensively, please make sure to leave your 2 cents in the comments below. That's all I got for you guys. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.